Hello and welcome to part 2 of this two-part Croner eCPD module on the taxation of corporate trade and asset sales prepared by Paul Davis. The first module explained what a trade sale is. It went on to look at some of the wider commercial implications and ended with a discussion of the tax consequences of the disposal of trading stock and chargeable gains assets. This module takes a closer look at other asset types commonly sold in asset sales and the tax rules which apply. It starts with a look at the rules applicable to the sales of intangible fixed assets, including goodwill and know-how. We then move on to consider the sale of assets on which capital allowances have been claimed, including integral fixtures. Next up is a look at terminal loss relief, before ending with a look at some indirect tax consequences, including VAT and SDLT. As was the case in Part 1, connected party situations, e.g. on the disincorporation of a company, are beyond the present scope. In Part 1, we saw that a trade and asset sale often forms part of arrangements designed to realise the value of shares in a company. And in that regard, an asset sale can be viewed as an alternative to a sale of shares by the company's shareholders. Where that's the case, the asset sale will need to be followed by a winding up of the company, so the proceeds of the asset sale can be passed by the company to its shareholders. The key tax feature of a trade and asset sale is that it will give rise to a number of separate tax charges of various different types. These charges may fall within a variety of different tax rules, e.g. trading profits, chargeable gains, loan relationships, intangible fixed assets, and others. The tax implications will depend therefore on the underlying nature of the individual assets or liabilities being sold and the available tax reliefs. It is important to remember that none of these tax charges will arise in the case of a share sale. In that case, the company simply continues to own its individual assets and liabilities throughout the sale process as it did before, and the only disposal is that of the shareholders' shares in the company, giving rise to a chargeable gain or loss. In Part 1, we looked at the tax implications of the sale of trading stock and chargeable gains assets in the context of a trade and asset sale. We'll now continue our investigation of different asset types with a look at intangible fixed assets. The disposal of an intangible fixed asset gives rise to an income profit of either a trading or non-trading nature, depending on the use to which the asset has been put. The distinction for tax purposes between capital and revenue expenditure is of no significance for these purposes. In most cases, the taxable profit or loss is the accounting profit recognised by the company in its financial statements. But further adjustments are sometimes required where the tax base cost and the accounting base cost are not the same. This can arise, for example, where intangible fixed asset rollover relief has been claimed on an asset. Where rollover relief is available, a gain on the sale of an intangible fixed asset can be rolled over into expenditure on new IFAs. The expenditure must be incurred in the 4-year period beginning 1 year before the date of the gain. This may not be available if the company is going to be wound up after the sale, as it is unlikely to be reinvesting in new assets in those circumstances. The sale of the trade and assets of a business will generally involve a disposal of the goodwill in the business. This can be taxed under the chargeable gains or the intangible fixed asset rules, so it's important to clearly identify which set of rules apply. This depends in turn on the date the goodwill was acquired, or the date the business commenced in the case of internally generated goodwill. Goodwill created or acquired by the disposing company before the 1st of April 2002 falls within the chargeable gains rules. Goodwill created or acquired on or after that date generally falls within the intangible fixed asset rules, but transitional rules apply if acquired from a related party. This present slide gives a high-level summary of the transitional rules. Determining when internally generated goodwill is created could be problematic, so it is treated as created before 1st April 2002 if the company's business was carried on before then. If the gain falls within the IFA rules, it's normally taxed on the basis of the gains and losses recognised for accounting purposes as per the previous slide. When calculating IFA gains on the sale of purchased goodwill, adjustments must be made to exclude expenditure that has already qualified for intangible fixed asset amortization relief. In this regard, the question of whether amortization relief was available can be complicated, as the rules have changed frequently in recent years. This is beyond the scope of this module. Know-how can also fall within either the intangible fixed asset rules or the chargeable gains rules, depending on the IFA commencement rules just explained. Pre-Finance Act 2002 know-how will therefore fall within the chargeable gains rules, and, by default, its sale will be taxed as a chargeable gain as long as it was used in the company's trade and the disposal in question is part of the sale of that trade. There is, however, an alternative treatment available by way of joint election by both the seller and purchaser. Where the election is made, the default chargeable gains treatment is disapplied and, as long as the following conditions are met, the consideration is taxed instead as a trading receipt. The conditions are, first, that the know-how has been used in the company's trade, and second, that capital allowances have not been claimed on the know-how in question. The election can therefore increase the amount of the profits taxed as income and reduce by an equivalent amount the amount of taxed as chargeable gain. This can be beneficial if, for example, losses brought forward from earlier accounting periods are available to relieve trading income but not chargeable gains. Whilst this may be less relevant now that carried forward post 1st April 2017 trading losses can be relieved against total profits of later periods, the election may still be helpful where carry forward against total profits is not available. Finally, and just for completeness, it's worth adding that if know-how isn't sold as part of the sale of a trade, then it will normally be taxed as a trading receipt. We will now consider the sale of assets on which capital allowances have been claimed. The asset sale will of course be a disposal event for capital allowance purposes. The disposal value to be brought into account on the disposal of capital allowance assets will be market value if the sale is for less than market value. The purchaser cannot claim plant and machinery or R&D allowances, and there is no related employment income charge. A market value disposal value is also brought into account where the purchaser is a connected dual resident investing company and there is no related employment income charge. In all other cases, the disposal value is the net proceeds of sale plus any insurance proceeds if relevant. For these purposes, if an asset is sold together with other assets, the net proceeds of sale is determined on the basis of a just and reasonable apportionment of the net proceeds of sale of all the assets. You should also be aware that all property sold under one agreement is treated as sold together, even though separate prices are agreed for separate items of that property, or there are separate sales of separate items of that property. Balancing adjustments will arise in all relevant capital allowance pools, either a balancing charge or balancing allowance. The balancing adjustment is the difference between the disposal value, determined as per the previous slide, and the tax written down value of the pooled assets. A balancing charge will increase taxable trading profits or reduce a trading loss. Likewise, a balancing allowance will reduce trading profits or increase a trading loss. Note especially that the annual investment allowance, writing down allowances and first-year allowances are not available in any accounting period in which the trade ceases. As a planning point, it may be beneficial to try to minimise the disposal proceeds attributable to capital allowance assets, thereby maximising the value of capital allowances already claimed and minimising any balancing charges arising. This will not always be the case, however, and each case should be viewed on its merits. For completeness, note that a disposal of capital allowance assets in circumstances where the company's trade does not cease does not normally give rise to balancing adjustments. In such cases, the disposal value is simply deducted from the balance of expenditure in the relevant capital allowances pool. The capital allowances treatment of fixtures installed in buildings can be complicated, to say the least, so it's helpful to focus on two key objectives. First, to ensure that the seller has maximised the value of capital allowances to which they are entitled but perhaps haven't claimed, and second, to help put the purchaser in a position to claim capital allowances on any fixtures they are about to acquire. So far as the seller is concerned, then, there is no general time limit restricting most claims for plant and machinery allowances, so old claims can still be made. The main exception to this rule is the acquisition of second-hand fixtures on or after 6th April 2012. In that case, both the pooling requirement and the fixed value requirement must be satisfied. The pooling requirement means that the qualifying expenditure must be added to a capital allowance pool by the seller, and the latest this can be done will be the accounting period in which the asset sale takes place. The fixed value requirement generally requires the making of a Capital Allowances Act 2001 Section 198 election to agree the apportionment of the sales consideration attributable to the fixtures in question. This must be done within 2 years of the date on which the seller originally acquired the fixtures. If either of these requirements is not satisfied, the seller simply can't claim any capital allowances on the fixtures it already owns. There may be much scope for tax advisors to add value in asset sale situations with a careful consideration of the apportionment of the sale consideration to fixtures. In this regard, it is generally beneficial to minimise the disposal proceeds attributable to capital allowance assets, as this maximises the value of capital allowances already claimed and minimises balancing charges. This will not always be the case, however, and if the seller can't use the additional allowances, it may be possible to pass the benefit of higher allowances to the purchaser in return for an enhanced overall sale price. Either way, it's generally recommended that the apportionment of the sales consideration should be documented in the sale agreement for clarity and the avoidance of subsequent disputes. Turning now to look at the position of the purchaser in relation to their acquisition of fixtures. In most cases, the purchaser will of course want to make sure they too can claim capital allowances on their respective expenditure on fixtures. Compared to the scenario on the previous slide, the tables are now reversed, and the seller may need to help the purchaser satisfy both the pooling requirement and the fixed value requirement. A well-advised purchaser is likely to want these requirements addressed in the asset sale agreement. The cessation of a company's trade caused by the sale of its trade and assets means that terminal loss relief may be available for any trading losses incurred in the final 12 months. This means the terminal loss can also include the appropriate proportion of the trading losses of the penultimate accounting period if the final accounting period is a short period. Where the conditions for relief are satisfied, the terminal loss can be set off against trading profits of the company arising in the 3 preceding years. Terminal loss relief is also extended in certain circumstances to a trading loss carried forward to the terminal period of the company. Note that if there are any unused losses that they will be lost. They cannot be carried forward for use by the purchaser, except in certain connected party situations which are beyond the present scope. This slide touches very briefly on the VAT consequences of an asset sale, which, in most cases, is likely to qualify as a transfer of going concern. If that is the case, then all supplies made will be outside the scope of VAT, and no VAT needs to be charged as a consequence. You would, however, need to consider the detailed qualifying conditions for transfer of going concern treatment if there was any element of doubt. Note that HMRC is no longer prepared to give informal rulings on whether straightforward transactions qualify as a transfer of going concern. It is strongly recommended that the seller should protect its VAT position by ensuring that the consideration is stated in the sale agreement to be exclusive of VAT. A stamp duty land tax charge, or a land and buildings transaction tax charge in Scotland, or a land transaction tax charge in Wales, may arise if the assets to be sold include interests in property. The general rule is that the chargeable consideration is any consideration in money or money's worth given directly or indirectly by the purchaser. Chargeable consideration for this purpose includes the release or assumption of a debt. Although this is a cost for the buyer, you should consider the implications this may have on the total purchase consideration that the buyer is prepared to pay for the assets of the business. This would clearly be a significant deterrent to an asset sale of a property-rich business, and a share sale may be a better alternative. We're now coming to the end of this module, and you'll soon be able to test your understanding in our short quiz. The key things to remember from the module are as follows. Firstly, in relation to intangible fixed assets, the tax treatment generally, but not always, follows the accounting treatment. And for the sale of goodwill, you will need to carefully identify whether any gain is taxed under the intangible fixed asset rules or as a chargeable gain. Secondly, the key to determining capital allowance treatment is whether there has been a cessation of trade. You will also need to take particular care in the case of fixtures. Thirdly, remember that terminal loss relief may be available, but that any unused losses will normally be lost. Finally, don't forget to consider the indirect tax consequences of the trade and asset sale, VAT, SDLT and its regional variations in particular. I trust you found this module informative. Please exit this activity and click Launch Quiz to complete the quiz. Once you've completed the quiz, you'll be able to print out your personal certificate. The module homepage also contains a link to the notes that accompany this module and to further resources available to you from Croner. Goodbye, and thank you for using Croner eCPD.
For further information and to view the full range of Croner eCPD modules, visit our website at croner.co.uk.